It's Friday, January 23rd. I'm Brian Walsh, and welcome to This Week in Impact, where I talk with ImpactAlpha journalists and editors about some of the most interesting impact investing stories we featured. This week, I'm joined by editor David Bang. We'll discuss the real returns of impact first fund managers, highlights from this week's all-star call on the topic, plus raising permanent capital to keep affordable housing affordable permanently, and finally, how Lendable demonstrates that asset-backed financing in emerging markets can have institutional appeal. That's all coming up on This Week in Impact. Hi, David. How are you doing this week?
Well, I'm doing pretty well, Brian. I'm not in Davos, which I think is a good thing.
I think so as well. And apologies to you and our listeners for my voice this week, going through a little bit of a sore throat. So hopefully it's not too distracting.
Seasonal allergies, you just call it.
There we go. All right. Well, first up, the fund managers finding novel solutions by seeking impact first. David, this week you hosted a call featuring some notable impact first investors who are demonstrating that impact investing isn't just for those seeking to optimize for financial returns. So why is impact first investing having a moment?
Brian, it's kind of return to basics, and folks are saying, it's not so much about concessions or market rate or the returns per se. It's about how you think about it. And basically it comes down to problem first, like take the problem you're trying to solve and then apply the appropriate kind of capital, but also other supports and other interventions, could be policy or other things, to solve that problem. And if you think about it that way, a lot of things sort of become clear versus this kind of, I think, time-worn kind of debate over, whether impact can or can't deliver market rate returns. Market rate is something of a social construction itself. It depends kind of what market, what asset class, obviously, what externalities have not been factored into the company, have been foisted back onto the public or onto communities. So we're trying to get away from that sort of framing and say, what happens when you look at the problem first?
All right. Well, run us through some of the highlights from the call. What were some of the key takeaways?
Well, Tara Murphy-Ford at Global Partnerships, I think, put it well, and which is that they're trying to solve poverty for in the billions of people, and so they do look at scale, but not necessarily at commercial rate of returns. Here's what she said.
For us, it allows us to invest in truly kind of those at the edge of where the market can work, those that are focused on real value creation there. And because we're focused on providing low cost debt, right, that's part of, impact first, focused on sustained market failure, creating the right incentives. It allows us to go into those social enterprises and say, look at, we know the economics of serving this segment is different, but the value that's created is value in and of itself. And that with the right data and the right capacity, with the right set of incentives, you can focus your product and service innovation, your growth strategies, your capital raising to stay the course on serving the hardest segments rather than drifting up market, where we continue to see the same, status quo business as usual gap in terms of what the market can do.
So what other perspectives stood out to you?
Well, by the opposite token, Hussein Sefian at Acre Impact Capital made the point that it doesn't always mean concession. They have a very interesting model. There's a thing called export credit assistance that many countries offer, and there's often a commercial lending tranche that's required. So in order to unlock this government essentially or public financing. And so they step in with this 15% commercial tranche, which means they're getting actually market rate returns. But on the other hand, some of those entities can't get that commercial capital. So they, in effect, unlock much bigger source of public capital with their tranche of debt. Here's what he said.
We try to demonstrate that impact first doesn't necessarily mean sacrificing commercial returns. So we target market rate risk-adjusted returns while being very intentional about our impact. And we don't rely on concessional capital, subsidized return. Instead, what we did is we identified a structural inefficiency in the market and innovated around that to identify a way to deliver both impact and financial returns.
Now, for all of the folks on the call, are they managing fiduciary bound capital, or is this more capital that comes from those that have a little bit more flexibility in how the capital is deployed, like family offices or foundations or the like?
Well, I do think it's interesting that many of them are for-profit impact funds taking investments, that folks want their money back, but are housed within nonprofit organizations that have found that they can mobilize more capital or have more leverage or have more scale with impact investing versus sort of just grants and things. So there is, I think, a mission-driven cast to the investors in these. But what's interesting is that kind of universe can be quite large. There's the foundations, obviously. There's the development finance institutions, obviously. But there's a growing crew of family offices that themselves are saying, "Hey, we've made our money. We're by and large, wealthy families. We want to put impact first." And so there's a whole set of impact first LPs coming to the fore as well, and that's creating, kind of a market response in these impact first GPs or fund managers who are saying, "Hey, we've got a thesis or we've got an approach that can deliver that impact to you, risk-adjusted impact returns." Sometimes people talk about.
So, what are some other perspectives that we heard on the call?
Well, Daniel Talalian of Echoing Green Signal Fund, that's an interesting case because Echoing Green, as folks may know, is been a longstanding backer of founders and social entrepreneurs and social enterprises, and they created a kind of sidecar fund to help those enterprises get off the ground. Now they've grown that up into what they call the Signal Fund, and they have a fantastic pipeline, super innovative entrepreneurs, and they put money behind them to get them through that kind of valley of death between getting their kind of proof of concept and getting to something possibly more commercial investors. Here's what Daniel said.
We're really proximate to the pipeline. The pipeline is almost like our family, right? And so we're very confident with the leadership and the models and the cultivation, and it's really about bringing the right kind of capital. And Eric, I was sort of feeling what you were saying, because at the end of the day, it's impact first. It's really founder first as well. And so there's really a focus on the founder and on the enterprise, not forcing a founder to pretzel themselves into a preferred product or an optimal portfolio construction or an incentivized return profile, to really give them the fuel that they need to solve the problem that they are proximate to. And that's just an inversion of power, right, at the end of the day.
Now, David, you had mentioned that Caroline Bresson of Open Road Impact had been somewhat of the impetus for this call. So where does she come in on this?
Well, Caroline and a number of other fund managers got together with the Miller Center down here at Santa Clara University and put together a study that showed what they call the true cost of impact first investing. And it had to do with the kind of technical assistance or other kinds of support that the fund managers give to their enterprises to help them succeed, the ability to sort of deploy capital efficiently, kind of operational aspects of fund management, and found that, in fact, these funds do deliver impact first, although sometimes it does cost them more just to sort of transact a deal and to close a deal because of this extra support. Open Road, as folks may know, started out providing essentially bridge loans for enterprises that were facing something they called it a OMG moment, where a contract was delayed or some kind of cash flow got interrupted, and they just needed to get across the bridge to somewhere where they could repay that loan. And they've kind of expanded their mandate, and they've even changed their structure to a nonprofit Open Road Impact. Caroline said that it really is just a kind of reversion or a return to the roots of impact investing itself.
I would posit that impact first investing is really just impact investing, and perhaps it's time for us to reclaim that term.
All right, well, you heard it here first. 2026, it's back to the future of impact investing. You can read a recap of the call and have a full replay on ImpactAlpha.com. There's also a link in our show notes. Later on, we'll discuss the implications of Lendable's latest $300 million raise for asset-backed debt financing in emerging markets. But for now, we'll take a quick break. When we come back, how permanent investment vehicles make the long-term viability of affordable housing possible.
Sign up for Impact Alpha's free weekly newsletter, Impact Alpha Open. A crisp, expert-curated investment briefing that lifts up people, data, tools, trends, and job opportunities to help you stay ahead of the curve. Find the alpha in impact. Visit impactalpha.com/open to learn more.
Next up, David, you and our Rudy Sonatas had a piece this week on two affordable housing investors who are making durable returns on the sector by using permanent capital vehicles. To start us off, what do we mean by a permanent capital vehicle and who typically invests in them?
Well, this is kind of a wonky corner of our world of impact investing. People might have heard of holdcos or holding companies as an alternative to what are the kind of classic 10-year closed-end funds, is the term of art that a lot of venture capital and private equity investors use, where you have an investment period and you find the companies, you buy them or you invest in them, and then towards 7 years in, you start unloading them, you exit them, and then you return your money to your investors. And that's kind of the standard model. The problem is you might have just gotten that company in your portfolio, nicely tuned and running well and delivering both impact and returns. And all of a sudden you've got to sell it to somebody else and they've got to maybe restructure it again. It's very disruptive to the companies as their investors have to continually exit. So in the world of private equity, there's a movement towards these holding companies, these permanent capital vehicles, where the portfolios don't have to be liquidated and investors get their money back in other ways through dividends and profit distributions and that sort of thing. And that's becoming a norm or a new trend in affordable housing as well, because the same thing applies. You buy a property, you buy a multifamily apartment building, and you get it fixed up, and you bring in some kind of social services, or maybe farmers markets, or health clinics, or job assistance. The tenants are happy. It's safe, because the biggest variable in these projects being safe is the long-term occupancy of the residents. They get to know each other. They look out for each other. So everything's moving along well. You don't want to have to sell that. And so Avanath Capital and Vistria Group have both developed over the past few years permanent capital evergreen funds, open-ended they're called, or all sort of mean the same thing, so that they can just continue to operate these affordable projects. And what's interesting is they like operating affordable housing. They don't want to turn them to market rate. They like the tax credits and the tax abatements and obviously some of those public subsidies, but they mostly like the fact that it's just super stable. Once you get into an affordable place to live, you don't want to move. And so they have long waiting lists. They have very low vacancy rates. And if you think about it, a month or two a vacancy in your, even market rate or luxury housing, that's just going to kill the profits for that year. So if you can keep somebody in that unit, keep them paying their rent, keep everybody happy, they're happy, you're happy, the community's happy, and these folks are sort of pioneering this kind of ultimately kind of common sense idea, which is that a decent and safe and clean and an appealing place to live is a good investment.
Housing affordability, David, is a structural, not a cyclical challenge. So it kind of makes sense that a permanent capital vehicle would be appropriate for that, because you have kind of long-term predictable cash flows, and it's not this kind of asset that can kind of necessarily grow and exit over time. So you don't have to worry about the forced sale.
Yeah, we've been watching this phenomena, which is that there were a bunch of rental restrictions put on projects that were built up, sort of 20 years ago, when these low-income housing tax credits and other things came onto the market. And so they are expiring. These rental restrictions are expiring. And folks like Jonathan Rose, like Vistria, like Avanath can buy up these properties where the rental restrictions are expiring. They can re-up for those rental restrictions, get a new set of tax credits and other things in some cases, and go forward as affordable. And in fact, some of the analysis we've seen shows that choice is actually better for their investors than if they had flipped them, which they're legally able to do now that the rent restrictions have expired. They're to flip them up to market rate or luxury housing. So affordable housing weirdly has become a very attractive institutional asset class for that kind of low risk, steady returns, and then social impact as the cherry on top.
So one thing I thought was interesting about the article was that Avanath Capital, they don't develop these projects; they purchase them from the developers some years down the road.
Yeah, well, different folks take different parts of the market. And Avanath, as you said, doesn't sort of break ground, generally speaking. I think they have in some cases. But they buy up these properties that might be 10 or 12 years old and fix them up and bring in, kinds of supports. Again, social services, health services, employment services, food, farmers markets and fresh food in some cases, all of which contribute to the quality of life, contribute to the occupancy rates, contribute to the rental payments. And they just say they like to be in that business of operating affordable housing, rent restricted affordable housing over many years. That appealed to Steve Ballmer. That's what we hooked the story to. Obviously, the former CEO of Microsoft, worth something, they say, of like $140 billion. Also, the owner of the Clippers basketball team. And it turns out that Daryl Carter had been a longtime season ticket holder of the Clippers down in LA. And when Ballmer came in, they became friendly. They're both from Detroit. Their dads were both in the auto industry. They started taking a look at some of Avanath's projects around LA. Ballmer liked what he saw, understood the impact, and put some money into both Avanath and Vistria.
So that's an example of a family office getting involved in this. What about some other institutional caliber investors getting involved in these kind of permanent investment vehicles for affordable housing?
It's interesting. Carter at Avanath told us that they're getting about half of their institutional investors now from Europe and effectively from 4 countries: Netherlands, Switzerland, Germany, and the UK. And apparently the connection there is that those European funds are already investors in what they call social housing in Europe. It doesn't have any of these kind of down market negative connotations that some investors still have around affordable housing. They understand these dynamics of steady cash flow and low risk. And he says, they just say, hey, there's a huge need for this. There's great market demand, so it's a great business.
All right. Well, you can read Rudy and David's story on affordable housing investor Avanath Capital on ImpactAlpha.com. There's also a link in our show notes. But for now, we'll take one more quick break. When we come back, how asset-backed fintech lender Lendable is demonstrating the institutional appeal of impact investing in emerging markets. Finally, David, ImpactAlpha's Jessica Pothering wrote this week about the $300 million first close from Lendable on 2 blended finance impact funds. While most of the financing has come from development finance institutions, this deal is still seen as a clear market signal that blended finance deals in emerging markets can attract institutional scale capital. So, David, to start us off, tell us about Lendable's business model.
Yeah, Lendable's raise was kind of notable because we've been writing for many months about, and many years, in fact, about how miserable the fundraising environment is. So the fact that they've been able to pull down this kind of capital in a tough market is sort of a testament to the appeal of the niche that they found. So they lend money to fintech lenders. So they're a lender to lenders, and these local fintechs are doing consumer lending, business lending, and other things in emerging markets. And Lendable targets kind of this, what you might call the second tier emerging markets, where there's not as many domestic sources of capital, and they provide this affordable, to a certain extent, capital for these lenders to on-lend to consumers. So it's a financial inclusion play, give folks the wherewithal to start their businesses, to manage their own finances, just in the same way that other consumers do with a kind of line of credit. And Lendable has been able to turn that into a business that can deliver sort of reliable 10%-ish kind of returns to investors. So it's sort of like affordable housing, as a matter of fact, steady, diversified, relatively low return. I mean, not stratospheric returns, but kind of steady and low risk. And they've kind of perfected that over a number of years. I think they're one of the oldest and biggest in that category. This time, they've also raised a fund that is lending to solar and climate kind of assets. So not just fintech borrowing, but putting a solar system on, or buying an electric vehicle or electric 2-wheeler or 3-wheeler, which is really the market in many of these countries. And that's a kind of asset-backed lending. And what's kind of interesting is that's kind of where Lendable started. That was their original aspiration and their original mission. 10 or so years ago, that was a much tougher market now that has matured in all sorts of ways. Cost of solar, cost of batteries falling sharply. So those things are much more economical. And now they've got back into that business that they had originally set out to get into.
So one of the things I found interesting about this story is that they had a credit rating or a rating equivalent risk assessment on the senior tranche of one of these deals that was able to then attract that larger pool of capital into the deal. So it's kind of getting at more of the systems level structured approach.
Yeah, and part of it is just kind of overcoming what are sometimes misperceptions of risk, and those kind of ratings help. But emerging markets, S&P Global says they're set to deliver something like 2/3 of all economic growth globally through 2035, and so you kind of want some exposure to it. Obviously there's all kinds of things, variables and risks that you might not know about, and so you want an outfit like Lendable that's doing its homework. They also are one of the few that require their borrowers to hedge their currency risk, which is one of the big risks in all of this, which is if you borrow in US dollars, but you're lending in local currency, and then that local currency gets devalued, you're kind of stuck in the repayment. And so Lendable mitigates that with hedges and other kinds of mechanisms. And so that helps give the investors some security and confidence that they'll get their money back as well.
Yeah, and I think the big thing here is that it's going from a bespoke idiosyncratic deals to more systematized phase of the development and maturation of this market.
Yeah, and especially on this kind of solar and energy and transportation model, they've got three borrowers on that already. One is a kind of commercial solar producer for flour mills in India. Another one is in Uganda, and it's kind of a two-wheeler, motorcycle, the boda drivers getting their electric motorcycles. And the third one is in India, and it's kind of an e-rickshaw business again. So small local operators, who drivers give folks rides around in their rickshaws now. Those are electric rickshaws.
There you go. All right. Well, you can read Jessica's story about Lendable's latest raise on ImpactAlpha.com. There's also a link in our show notes. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thanks, Brian.
And thank all of you for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks as always to our producer extraordinaire, Isaac Silk. For David Bank, I'm a hoarse Brian Walsh, Managing Director of the impact advisory firm Human Nature. We'll see you next week for more Impact.